I'm Ryan Coyle. I'm the broker, owner, CEO of Connect.ca Realty. Thank you for joining us. We used to do a lot of this stuff online. 3-4 years ago, we used to do it in person, so it's great to see faces again. I'm going to be around after this presentation to take any questions. If you guys want to talk about your portfolio, talk about your plans for investing, I will be available. Let's jump in. I think this is probably going to be about, let's try to keep it under an hour. But I've got we've got a lot of information. The market's changing. I'm really excited about what we're seeing in the market, so we're going to cover all that. I've got Delia here. Delia, if you want to just put up your hand. Delia is a mortgage specialist. She works with a lot of investors. She helps investors scale to find more financing options and build portfolios. She's going to speak for 10 minutes, and she'll be sticking around as well to help you guys if you have any questions regarding financing. So, agenda, we're going to talk about the state of the market. We're going to look at a macro overview. So we're going to look at what's happening in the Canadian market. We're going to look at micro overview, what's happening in Ontario, in the GTA. We're going to look at supply and demand fundamentals, which is the driving factor for real estate prices and prices for pretty much anything. We're going to look at why today is the perfect storm for investors. That's a bit of an oxymoron, but we'll get into that. We'll look at why now is the time to invest and why I'm investing. Now we're going to talk about my portfolio. So I don't have a $100 million portfolio today, but what's key is with the principles that aren't new to me, what are I guess unique to investing and especially in real estate. I've been able to build a portfolio that we'll take a look at today, and that portfolio, given historic assumptions, will be worth $100 million in my lifetime. I've called that the investor operating system. We'll break that down, what that is. Then we'll look at the multiplier effect, which is essentially my portfolio. We'll look at how I took one property, I've turned it into over 40 doors by constantly refinancing and building my portfolio. And we'll talk a bit about how I did that. And then we're going to look at Hamilton. So in Corktown condos specifically, I started investing in Toronto probably a little over 20 years ago. The real estate market here has been very good to me. I identified an opportunity in a market that supply and demand suggested prices would continue to grow over the long term. We've obviously seen that growth everywhere over the last few years with population growth, but that'll normalize at some point, and you're going to want to look at markets that have those supply and demand fundamentals that will give you long-term growth and certainty of long-term growth. And why I really like Hamilton is because Hamilton, unlike other GTA cities that connect directly to Toronto, it's built to be a metropolis. It's a waterfront city, it's a transit city, it's a major university city, so we'll get into that. I really like Hamilton and Corktown condos. The condo boom, everything that we saw happen in Toronto, I'm seeing the same things line up in Hamilton, and that's why we're talking about Hamilton today. I'm going to look at some financial projections, and then we're going to do look at the VIP incentives and pricing. And then happy to answer any questions. So for those of you who don't know who we are, I've got a team, they're outside. I'll introduce them at the end. But we're not realtors in the traditional sense. We take more of an investment advisor approach to selling real estate. And we like to do a deep dive analysis in different projects in different markets. We don't just send out any project. We like to focus on projects that I invest in a lot. But we think are good investments. We're not going to send you 30 projects a month that as they release. We're focusing on fundamentals of what make a good real estate investment. And it's really important because there's a lot of noise out there and there's a lot of experts. And there's also a lot of sad stories you read about in the news and social media where people have maybe invested in the wrong market, the wrong building, and they may have lost money or may not been able to close on a property. So I think it's very important, whether it's me or another accomplished real estate investor and real estate agent, I think it's important to work with someone that has accomplished what you want to accomplish. Very important. This is my group of companies here, Marco Property Management. Again, investment advisor approach to selling real estate. We try to make owning real estate as easy as owning a mutual fund. I acquired that company about 5 or 6 years ago. We manage a lot of our clients' units. Anyone who buys today at Corktown, invests today, will be offering free, we do this for all projects. We do free leasing services, free listing services. We advertise the properties, we find the tenants. We don't charge for that in the first year, and we do free property management for the first year. We also have advisors and teams that we work with. Dahlia, for example, is a wonderful mortgage broker. I wouldn't just invite any regular mortgage broker. She works with investors. She's an investor herself. She can help guide you guys to make the right decisions. Very important. So let's take a look at the macro market overview. And I mean, this I'm sure everyone is aware of. Over here, we've got a serious population growth story happening here in Toronto, in Canada. We've got record immigration. We had over 1.2 million people come into the country over the last year in 2023. That's made up of permanent and non-permanent residents. Even if you take out the NPRs, the non-permanent residents, we're still seeing record growth. Now, this is going to pull back, but it's going to remain for the unforeseen future well above the long-term average of population growth. Simultaneously, what's happening as population demand is going up, our housing starts are dropping. They're actually plunging for low rise particularly, and that's an affordability thing we'll talk about. High rise will become more affordable for the masses, so we'll see a lot more of that. So this is a really good chart that I like to show here. So since 1972, Canada has averaged roughly 200,000 new homes a year. So whether the market has demanded more, they've only been able to build, the country's only been able to build around 200,000 homes. So regardless of population driving demand, we have a serious supply issue to be able to build to keep up to that demand. We have a similar story in the GTA, where the GTA has averaged roughly 32,000 new homes every year, and it's never been able to build more than that. That's been an average for over 20 years. So as more people come into the market and want to live here, we're not actually building nearly enough homes to service them. So interest rates, probably the hottest topic for real estate investors right now. Positive news. First rate cut is expected in March. Some think it's later. With the recent announcement, things got shuffled around a little bit. That's all based on words. But what the professionals or the industry people are suggesting is, in November, they were expecting rates to drop in 2024 to 4.25. In December, that changed to 3.75. Now a lot of the experts are believing it'll drop to 3.5% in 2024. So it's reasons for optimism. So we're already seeing it, the 5-year discounted mortgage rate. I haven't seen a mortgage with a 4 in front of it for the last, maybe 18 months. We're seeing 4s. That's the start. Mortgage rates haven't started coming down. Now this is exciting for people wanting to get in the market. It's really exciting for people that are in the market. Who's feeling the squeeze of higher interest rates right now? Right, so am I. So this is very, very positive. And we're already seeing it on the resale side. There's a lot of sentiment coming into it. I'll get into that. So discounted rates around 5.2. Again, I've seen one as low as 4. What's the lowest rate right now you've seen?
Yeah, 4.2, 4
Yeah.
point insured.
Insured, yeah.
Everyone's asking with who?
With who? There are multiple lenders. If you go to a site called Rate Hub, you will see all of the lenders who are offering discounted rates right now.
But you said those are insured.
The 4.2 is an insured, meaning that's less than 5%, less than 20% down. But the non-insured are in the later 4s, 4.8, 4.8.
We're getting there, guys.
4.7, 4.8.
The moral of the story is we're turning a corner.
Yes.
It's a big corner. I get it. There's a lot that's happened over the last few years. So these are the experts. These are the major banks. I mean, there's a general consensus that rates will be closer to that 3.5% mark. But what is this really? I mean, the underlying problem, again, it all comes down to supply and demand. We can complicate this, and we could talk about all this data and this data. It really simplifies down to supply and demand, which we've gone over. And when the government increases rates, I look at it as a bonfire. This fire is not going out. We know what the major problem is. It's supply and demand. All rates are doing is throwing water on this fire. This fire is going to take back off as soon as rates start coming down again. And we're already seeing it. So this is the consumer sentiment that I talked about. And I saw this firsthand. So in the first, 3 weeks into 2024, we've already sold 6 resale listings. I've sold them in the first 2.5 weeks of this year. I hadn't sold 6 resale listings in the last 3 months of 2023. That is how quick it is changing. Now, I do think when I say a big corner, it is changing. Typically, if you guys remember last year, when rates went flat, everyone jumped back into the market. We saw double-digit growth last year between, I think your baby's ready to invest. So last year, if you guys remember, I think it was around February, March, there was no more rate hikes. Prices skyrocket. All that demand sits on the sidelines. It comes back off the sidelines. That money comes back into the market and prices go up. The question isn't if, the question is when. Now we're already seeing, this is very positive, especially for Ontario. This is Canada-wide. Canada saw sales increase 8.7% in December, and in Ontario 16%, well above all other provinces. New listings were down, so supply is down, demand is up. In Canada, 5%, 11% in Ontario. So let's look at the micro market. So I'm talking now, I want to focus more on Toronto, the GTA, Hamilton, and Ontario. So this is what I just talked about. So December data showed the largest monthly increase in sales since April of last year. That's the market sentiment. People wanted to make sure rates weren't going up. They're already coming into the market with rates being flat. When rates start coming down, I think we're going to see a lot of that demand flood into the market. So monthly home sales, you'll see here, starting to go upwards. And this is a really interesting stat here. New homes, 1995 was the last year when sales were as low as they were in 2023 in the GTA. New home sales, that means the homes that supply people moving into the city, into the GTA, were the lowest last year since 1995. So we're going to have a further supply issue based on that alone. Existing homes in 2000 was the last time when overall sales were as low as they were in 2023. So sales were around 66,000 in GTA last year. The last time they were that low was 2000. That means buyers aren't disappearing. They're not going anywhere. They're on the sidelines. They're waiting. They're waiting for the market to improve. Do you have a question?
Going back to that first slide where you're talking about 1.2 million immigrants to Canada, does that include foreign students?
Yes, NPRs, yeah.
Ryan, if I may ask,
Yeah.
on the resales that you did in January, are you seeing multiple offers
Some.
start picking up again?
Yeah, a few of them. Some of my colleagues have. On one of my properties, I had multiple offers.
What are they above the asking?
Above asking. So one of the properties, to put that in perspective, one of my properties, I had it listed at 620. For the last 3 months of 2023, no offers. I got a whole bunch of offers the first 2 weeks of January, as low as 520. I ended up selling it at 615 last week. So what always happens when a market starts to turn, the sharks start to swarm. Okay, so there's confidence from savvy investors. They come to take advantage of a situation. We saw that in December, and now we're seeing that on the resale market. So starting the assignment market. There's a lot of opportunity in the assignment market. People are taking advantage of it. Now we see it in the resale, but then after the sharks comes normal people because now there's confidence in the market. So they're always a little bit ahead of it, and that's a good sign that the market's going to turn. Sales to new, so this, I talked about this, but sales to new listings have jumped 38% to 53%. So we were in a deep buyer market in the GTA. Now we're in a lower end of a balanced market. It's turning. There's still a lot of work to do. Like I get it, rates are still high, but these are all of the right signs. Now, this is really interesting because anytime I'm investing and I'm talking to you guys, we're talking about investing for the long term. This shows you what's happened over the last 5 or 6 years. Last year we had an increase in the GTA of 0.26%. That's all housing types, low rise, high rise. But, and it's been the toughest market. Last year was the toughest real estate market most people has ever seen. It's the toughest market I've ever seen, or anyone I know in the industry. And the 3-year increase is 4.4% per year. So when you take away those bad years or the bad years of high rates or policy, whatever the case may be, when you're investing over the long term, the supply and demand fundamentals always win. And 5 years, it's even deeper at 7.5%. So that takes that really, really shitty year last year, and it gives you a long-term average, which is actually quite appealing. Now, what's really important that I don't think everyone always considers is we look at the market, okay, the market only went up 2% this year, 4%. Let's look at the 3-year increase, what that really means. You bought real estate with 20% down. If the market went up 4%, that's a 25% return on your money. That's significant. A lot of people are just sitting there waiting for things to change and lose money in the bank to inflation. If you're investing in real estate over the last 3 years, the toughest 3 years I have seen in the last 20 years, you would have made a 25% return on your 20%. Months of inventory, and we've talked about the inventory story, so it's starting to go down, going towards a more balanced market. This is some really interesting data, obviously on the rental side. We're investors. The rental market's been red hot. People need a place to live, so they haven't been buying as much, so there's a lot more demand for renters. The last few months have been really tough in the rental market, but I think a lot of it is seasonally adjusted. I also think we had a large demand going to the rental market that boosted prices, and they pulled back a bit. But right now we're seeing a seasonally adjusted rental market. I truly believe in the GTA we'll see 5 to 8% rental growth over the coming years based on a shortfall surplus issue. What's interesting here is if you look at the 3-bedroom year-over-year growth, it's 14% compared to a 1-bedroom that's 6%. Now the reason why that is because affordability. Supply and demand and affordability are things you always need to look at. Affordability is going away from low-rise and it's moving towards high-rise on the rental and the resale side. So 3-bedroom condos are now seeing a lot more demand from families or tenants or students who want to share rooms and meet online to rent a 3-bedroom that's cheaper than a 1-bedroom by themselves. So I think we'll see a lot more of that in the coming years. In fact, I believe that so much in the last probably 5 or 6 years, all of my purchases have been 2-bedroom and dens, and 3-bedroom condos. This is a report from CMHC and RBC that shows a huge shortage of needed rental units. This is on the purpose-built side, but by 2026, they're expecting the current rental shortage to actually quadruple. So supply and demand. This is the Webster Dictionary definition. The amount of goods and services that are available for people to buy compared to the amount of goods and services that people want to buy. If less of a product than the public wants is produced, the law of supply and demand says that more can be charged for that product. The reason why I try to dumb this down is because real estate doesn't need to be so complicated. There is a lot of noise out there, but when you're investing for the long term, the truth is supply and demand. And if you're investing in the right market, in the right building, in the right neighborhood, you're always going to get ahead over the long term. This is a really interesting stat. So in 2022, 72,000 homes were built in Ontario, where we actually needed 192,000. So we had a shortfall of 120,000 units in 2022. It's a similar, if not a worse story in 2023. I just haven't got that data yet. And population growth, we know in Canada is rampant. Where do they end up? Majority of them actually end up, I shouldn't say the majority, but a good amount of them end up in Ontario. And where do they end up after that? In the GTA. Okay, so there's a lot of markets like Alberta that's getting a lot of noise right now. Right now, that is a lot of demand coming to a market that doesn't have the same supply and demand fundamentals. The majority of them will always end up in the GTA. And this is a great slide from our friends at Greywood. Greywood is a very reputable builder. They actually do a lot in Alberta and Canada, in Toronto. They're Canada-wide, and they've indicated in the GTA, we're short about 159,000 units. So remember I said Toronto GTA is building about 30,000 units a year? This is 6 years. If you go look at the last 20 years, it's the same thing. We're averaging about 30,000 units a year. Doesn't matter how hot the demand is or how bad it is, there's always a shortfall of units needed. This is a headline. This just kind of adds to the story what's happening in the GTA. You guys probably used to get a lot more emails about projects that we're launching. There's a lot less of them now. That's adding to the supply story. So we've got a lot of units coming online over the next few years. But in the next 4 or 5 years, there's going to be a huge shortage because there just haven't been builders launching inventory. because of sales and because of costs, to be honest. Construction is slowing, another supply issue. Bank of Canada indicated the job that immigrants are least likely to have, and this blows my mind. We have all these people coming to the country. We should be getting skilled workers to help us actually build more housing. But that's not the case. In fact, it's the least likely job they're going to take. And on top of that, our workforce is significant part of it is going to retire over the next 5 to 10 years. And you can see here that this shows the amount of money that has gone into building. It obviously dropped during 2020, spiked when things were good, and it's dropped over the last year and a half. So what does this all mean? This is great because this is government. CMHC came out with this report. They're an arm's length part of the government, but they came out with this report to assess current policy with construction and with immigration, and they believe that Ontario, we're only talking about Ontario today, but the number you can see is much higher than all other provinces, is expected to have a shortage, a supply gap, they call it, of 1.48 million homes by 2030. That's a big number. So what does that mean for investors who are taking advantage of this situation? Supply and demand. Well, they believe, CMHC believes that if policy remains the same and supply remains the same based on policy, they think it could be as high as 98% price appreciation from 2019 to 2030, roughly 10% per year. On the low side, if policy, immigration, everything stops, they're thinking it could be 74%. They're estimating 86%. In Ontario, we know the majority of that growth happens in Toronto, in the GTA, I should say. So this is a really important slide because this takes a much longer picture. For those of you that are here to create multi-generational wealth, want to buy for the long term, this is exactly what I'm doing. These are the numbers I look at. And these are different for different markets as well. This is the GTA. But what you can see here is, the 80s. There's a crash, a recession in the 80s. Prices still went up. There was a crash in the 90s. Over a long period of time, prices still went up. There was the dot-com bust in late 90s. 2007 financial crisis, 2017, that was a crazy year where a bunch of policy came into effect. The government started introducing international buyer bans and stress tests, all kinds of stuff. Prices went off a cliff, they went right back up. Supply and demand. So why is now the perfect storm? Well, developers are offering things to get projects moving forward. There's an opportunity for buyers in the market right now. That won't be here forever. Heavily reduced closing costs, aggressive deposit structures, incentives. So a lot of developers want to move inventory right now, get to construction or finish construction. They don't want to be sitting on inventory. It's not moving as fast as it used to. So we're seeing very aggressive deposit structures, really great incentives that we have not seen. And if the market were hot, we would not be seeing. You can invest today with less money down and wait 4 or 6 years to take out a mortgage, so we're not dealing with mortgage costs. And we know mortgage rates are coming down because what goes up must come down, and that goes for pricing as well, an inverse correlation. As rates go down, we're going to see prices start to go up. So key takeaways, 2023 was a market to remember and forget. We are turning a corner. I don't have a crystal ball. I don't know if it's a big corner, small corner. I'm very optimistic about what's to come in 2024. I'll say this on camera in front of you guys. I believe condos will be up double-digit growth by the end of the year based on rates coming down. And GTA real estate remains resilient, and it performs incredibly well over a long period of time. I mean, we've seen the data. Toronto, GTA specifically, but Toronto as well is just like the most resilient market. I mean, can you believe that we've had so little sales, our worst year ever, and we've been pretty flat in prices? We're actually up 0.26%. It's remarkable. Supply and demand, unbelievable population growth is meeting falling supply. That's a huge indicator of what's to come. Repeat of spring 2023 when rates went flat. Do we think that's going to happen again? We don't know. Toronto home sales surged and new listings are evaporating, so it could. All right, so I'm going to walk you guys through the principle that I've used to build a portfolio. I used to invest in multi-res. I had a few multi-unit properties in Hamilton and Brantford. I became very burnt out. It became a full-time job. And I bought my first condo at Bay and Dundas, and my mom helped me buy one as well. And my tenant, I never heard from my tenant for 3 or 4 years. It was amazing. It was near the university. And I was like, okay, now I can own 20 properties. That was always my goal. I couldn't do it when I was investing in low-rise. I'm sure a few of you guys in here, a few of you in the crowd can relate to that. Condos allows you to scale a portfolio. And these are not unique to pre-construction. This is for any real estate investment. But I'm going to explain how pre-construction can help amplify a lot of these. So what are the pillars? I call the IOS, the Investor Operating System. Well, it's leverage, compound interest, passive income, and time value of money. Robert Kiyosaki from Rich Dad Poor Dad, very successful real estate investor. He said, leverage is the reason some people become rich and others do not become rich. Pretty plain and simple. I believe it wholeheartedly. Other people's money. So it's OPM. That's a common term we hear. Other people's money, the bank's money, and your tenant pays the bank back. But pre-construction is a little bit different than your traditional real estate investment. It's the ultimate leverage. You can actually invest today without a mortgage. You can't do that anywhere else. I mean, let alone get leverage. Real estate is one of the only investments that you can get leverage through a mortgage. You might be able to get it through your bank on your portfolio, depending on your net worth. That could be called at any moment. It's very expensive. It's very risky. Real estate leverage is the way to go. It's the way to build wealth. But with pre-construction, you could invest today with as little as 5% and get free leverage without a mortgage. So the miracle of compound interest. Albert Einstein, I like my quotes. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. I don't know if he was a real estate investor, but he was a really smart guy. And I think when you talk about compounding, you could apply it to anything. You see compounding, it's incredible what it does. And I'll show you what it does to my portfolio over a long period of time, and hopefully yours. So it's the snowball effect. That's often referred to in real estate. It's when you earn interest on your initial investment and then interest on interest. Here's a quick example. $100,000 investment made in the TSX in 2022 today would be worth $275,000 or 176 return on ROI. $100,000 invested in real estate, in GTA real estate in 2022 with a 20% down payment, so there's some leverage and compounding, would be worth $2.16 million today. And that's based on not like a future assumption, that's based on historical growth or a 2,000% return. How to generate passive income. So this is what I talked about when I mentioned being able to scale a portfolio. I would have never been able to do this with multifamily. The cash infusions. I have a few multifamily properties right now. They're exhausting even though I don't manage them. I'll be selling those when the market picks up. But the whole point of pre-construction is it just allows you to do more with less. You're buying a property today, you're putting it in your filing cabinet, and it's appreciating well above the market because new properties appreciate higher than older properties, and it's passive. And that's the only way I would have been able to scale the portfolio that I've been able to is through pre-construction. My grandfather used to say, Ryan, figure out how to earn money while you sleep, and then find multiple streams of earning that money while you sleep. And you can work, if you're able to, maybe 2 or 3 or 4 jobs, but you can own 10 properties and have 10 different revenue streams. So the time value of money, this ties it together. We already saw this slide. I just want to highlight again, the time value of money is really what eliminates risk from a real estate. I don't want to say eliminates, but hugely reduces it from real estate investing. And when you're buying pre-construction, you've got a long runway from, if you're buying the right pre-construction, a long runway from putting down a deposit on that highly appreciating piece of paper, and then till it's actually completed. And I showed you guys when, the 3-year difference, the 5-year difference, it doesn't really matter what happens over a year, it's what happens over 3, 4, 5 years. So all of this turns into the multiplier effect. And essentially it's buy, rent, refi, and repeat. And this is exactly what I've done, and I'll show you. And essentially equity in your property isn't working for you if it's sitting there. So you want to make it work hard. Most Canadians are sitting on a mountain of cash in their primary residence, which can be used to build wealth. Refinancing is the best tax avoidance strategy to ever exist, and it's tax deductible. I am not an accountant, and I don't give accounting advice, but let me just unpack that. So if you are to refinance a property that has $200,000 in equity, you are not going to pay tax on that money. You pay tax when you sell the property. That's huge. Not only that, that interest you pay to pull that money out, you're actually deducting that from your income. I call that double dipping. It's all above board too, which is crazy. That is a huge thing, and that, when you're leveraging and compounding, is a significant component. So I've done literally this, and I've turned one property into 40. This is an example of a property that I refinanced when the market was up last year before rates started going down again. I bought this in April 2017. 2-bedroom for $602,000. Downtown Toronto, I had it appraised at 1.175. It's renting currently at 39. So when I went to refinance this, so you guys understand it, my current mortgage was $482,000. 1.175 was appraised value. 80% of that was $940,000, so I was getting $940,000 back on the refinance. I had to pay off the original mortgage of $482,000, and that left me with $457,000. I didn't pay any tax on that. I will, when I sell this property, I'll pay a capital gain, but I'm not going to sell that for 20, 30, 40 years. So this is an illustration that came up that really highlights this when you start refinancing and buying more. When I had made this, I used a purchase price, I think it was average price in Toronto at the time, $710,000, 20% is $140,000 down payment. I'm using a high annual price appreciation here. The market was much better when I made this chart. But when you look at the 10-year average in Toronto, it's around 7.5%. Might even be closer to 8, I don't know. Anyway, it's high. So I was using 7%, which was below the 10-year average. Regardless, the numbers are staggering. So what happens is you buy property 1 today, $710,000, you put down $140,000. 6 years, when the property is ready and you've rented it out, you refinance it. You buy property 2 at $995,000, and you take the refinance and you buy it with no money out of your pocket. In this situation, if you want to double down and have 6 properties in 25 years, you would have to put down an extra $169,000 out of your pocket to buy property number 3. So you're into this investment about $350,000 once you factor in closing costs. Year 12, you have enough equity to refinance 1, 2, and 3. You buy property 4 at 1.3, property 5 at 1.3, property 6 at 1.3. And what's important here is when you look at the equity and your wealth grow, in year 1, you put down the 140, so you got a portfolio worth 710. Portfolio in 6 years at 2.9, but your equity is only 597. Start compounding. Portfolio in year 12 is 8.3 million. You have equity of 1.6. This is crazy. In 13 years, you go from 1.6 to $15 million. And in 25 years, when you retire, you've just created your own pension. Now, this is my portfolio I'm going to share with you guys, and I say this all the time, all about time in the market, not timing the market, because you can't time the market. But when you're investing, if I buy a condo today and the market goes down tomorrow, I personally never care. It doesn't matter, because I know what it's going to look like in 5 years, or I'm confident what it's going to look like in 5 years. And that's why we got to shift our mindsets. If you guys want to build serious wealth, you want to do it through real estate, but it's through the long term, because you want to eliminate that risk. So today my portfolio is valued at $36 million roughly. In 20 years, at 4%, it's 80 million. In 30 years, if I do nothing else, if I don't refinance and redeploy and do what I've been doing, I'm doing nothing. At 4%, it's 120. And in 60 years, for when I pass it down to the next generation, 80 years, I mean, you get the idea. It's pretty crazy. The reason why I've done so many years, actually James is back, that we had fun playing around with our portfolio a few months ago, and we're like, you know, what is this all for? We're going to hand it down to our kids. And we're like, well, what does that look like? And we started talking about trust structures, and now I'm setting up a trust where I'm going to be able to protect the real estate assets, but the children and grandchildren will benefit. So this is actually a realistic number of what my portfolio will look like in years, but it also highlights compounding. So say I do nothing, 4%, very, very conservative growth. I do not think it will be as low as 4% based on the supply and demand we discussed. But let's say it is. In 100 years, my grandchildren are going to have a portfolio worth $1.8 billion. And we're not even talking about the cash flow. We're talking, at that point, millions of dollars of cash flow. Now, if I take the 45-year average, which I truly believe we're going to see more than what we've seen in the last 45 years, based on the supply issues we're having, in 20 years, that's 133 million instead of 80 million. It almost doubles in the first few years. I mean, the numbers get a little unbelievable at this point. I had to run it through a number of models. They're real numbers. But anyway, the whole point is to highlight that if you do it for the long term and you do it through real estate, that it'll do very well. So the key takeaways, the iOS, a tried, tested system for generating wealth. Work with someone who walks the walk and can truly guide you. The multiplier effect, it's how you can turn one property into 40. What we do is we try to help our clients turn one property into 7. And we sit down and we really analyze people's portfolios, their situations, and we can help you put together a plan. I want to share a quick story. I met with a client last week. They had 3 properties under their name, personal name, and they had 4 that were going to close. They couldn't get financing on the 4 that were going to close. So I looked at their portfolio. 1 was their primary residence, 2 were in their name. I looked at their mortgage. They were spending about $13,000 a month in negative cash flow, mortgage payments, and they had about $800,000 in equity. So what we did was, I'm going to be selling their properties. We're going to be using the equity to go and buy 7 or 8 more properties. We're just finalizing everything now, and they're going to buy through holding corps. So we help clients figure out how to build a portfolio, to scale a portfolio, and not a lot of people know that, and we don't talk about it a whole lot, but when you structure your portfolio in the right way and you get the right type of financing, you're not going to run into the same problems to finance units that other people have. I just wanted to share that because if you guys want to scale a portfolio, make sure you're working with someone that has already done it. Pre-construction is the ultimate leverage. We talked about that, so it allows you to invest without a mortgage. It's as easy as owning a mutual fund and the easiest way to scale a real estate portfolio. Time equals money and reduces risk. Real estate is one of the safest and easiest ways to grow serious wealth, multi-generational wealth, and passive income. It's the hands-off investment that earns money while you sleep. And Dahlia, if you can come show us the way with financing.
Fantastic. Ryan, thank you very much
Yeah, of
for
course.
the opportunity to be here today. Good afternoon, everybody. It's fantastic to see you come on a Saturday morning, but I'm sure it's worth your while. I love the fact that Ryan touches on economic fundamentals when it comes to investing in real estate. I work with thousands of investors. I've seen investors succeed, I've seen investors not do so well, and I can tell you what Ryan shared today is gold, focusing on the economic fundamentals. Location and demand and supply is key to the overall performance of what you invest in. So, regardless of where you are in your investment journey, whether you're looking to buy your first property, or you have a few and you're looking to scale, or you're looking to become the Grant Cardone of the world, owning a big portfolio, guys, I can tell you that money is the fuel that will get you there. So in the 10 minutes that I have, I'm going to share with you from a 50,000 view level, how do investors actually go about financing large portfolios? What are some of the roads that they take? And I'm going to, at the end of this, give you a complimentary session to dig deeper if you want to dig deeper. So there are 4 paths investors take when it comes to getting mortgages and money to grow their real estate wealth. The first one is what I call residential financing, all right? So I'm going to show you each road and I'm going to let you know a little bit about it. So residential financing is the first one. This is the road where you meet the banks, the credit unions, the alternative lenders. So for those of you who are looking for some names, you know, the big five banks, BMO, RBC, CIBC, TD, alternative lenders, Home Trust, Equitable Bank, Optimum Mortgages, these are just some names, and the credit unions. This first path is the first path investors take when they're buying rental properties. And through this path, you go to these lenders, you structure your portfolio, you get mortgages, and you can get up to 40 properties in your personal name or corporation. This road is full of turns and twists. What do I mean by that? These lenders look for your credit, they look for your income, they look for the property characteristics, they want to know a bit about the rental income, they want to know where the down payment is coming from. There are turns and twists. I used to work for BMO myself for 15 years. I didn't know about all of these turns and twists. I would go to the bank and say, oh, I have a rental property, I want to finance it, can I get a mortgage? And I would wait for, yes, you can, or no, you can't. Or I would get an answer, yes, you can, however, you need to put a little bit more down payment. So from the outside, we only see the mortgage rates. For your primary residence, you can go and chase the mortgage rates. But for rental properties, you really need to understand how these banks and lenders think. You are not sitting in it every day, so the best thing to do is to work with a mortgage advisor who breathes this every single day. Because we then strategically make sure that as you grow, we get you the best type of money at any point in time. Okay? So the best down payment, the best interest rates. And make sure that you're not going to hit what I call a wall. What's a wall? If you go randomly about financing your rental properties with the banks or these lenders, you will get to a point where they're going to say, you're done. I can't get you beyond 3, or I can't get you beyond 4, but I'm telling you guys, here, we can get you up to 40 properties when it's done right. So that's the first path real estate investors take. And I suggest that you maximize on this as far as you can before you consider any other type of money, because you're going to save money. So I have investors who get up to 30, 40 properties using the first path. And then what? What do they do after that? Well, here is another strategy. It's a money strategy. This is for more of the advanced investor. You're basically, your baby loves this strategy, gets excited about it. What are joint ventures? Does anybody raise of hands? Do you know what joint ventures are? Okay, excellent. So joint ventures is when you use other people's money and you partner with other people to basically grow your real estate portfolio. So I'll give you an example. I am an expert, let's say, or I'm going to use Ryan. Ryan is an expert in locating great opportunities in great locations, and they are condos. I have no idea how to do it. So I'm going to go to Ryan and say, Ryan, I want to partner with you, okay? I'm going to bring the money to the deal. I'm going to bring the credit to the deal. And you find me an opportunity, Ryan, and you just give me my return every month. That's called a joint venture, partnering with somebody else. When do investors do that? Investors do that when they've personally maxed out with the lenders. They can't get any more money. They don't have any more down payments. They cannot get it because of credit. They go find other people who can help them out. So they partner up with these people. This strategy is beautiful because think about it. You can technically grow your wealth indefinitely if you want using other people's money. If you know how to partner, how to find opportunities, right? But now you're splitting the rewards. You have a pizza. Instead of owning this pizza on your own, you're splitting it with somebody else. But sometimes it's fine. What is the downside of this? Does anybody know what is the downside of this?
You have partners.
Exactly. You have partners. You're marrying somebody.
You're sharing the equity.
You're sharing the equity. And you're also marrying somebody. Now you're not just building a real estate portfolio, you're managing expectations, you're managing relationships. Somebody wants to, know how things are doing, and you have to report back to them. So you're building a portfolio, but you're also managing relationships. When do you use it? When you run out of options under path number 1. And I've seen investors go down this route as long as they understand it and take their portfolio beyond the 40 or 30 properties I mentioned earlier. So that's number 2. Number 3. Whew, this is the highway, guys. Okay? This is the speed highway. All right? There are no stop signs. There are no rules. There are, like accidents here could be fatal. Why am I saying this? Because private money, this is private money. There is actually an abundance of lenders that you don't see through the banks and the traditional lenders who are willing to lend money to real estate investors, or anybody, in fact, as long as you're willing to pay the price. So to give you an idea, they can charge 11%, 12%, 13%, 14%, but they make their own rules. You can buy a property, you can ask to borrow money from them and get 100% mortgage. Someone may be willing to do it, 0 down. So I've seen investors use this type of money. But when you use this type of money, you really got to understand, what are you signing up for? How are you using it? It's a two-edged sword. It's not all about getting a piece of real estate with 0% down. Okay? You really got to know how to use this type of money, but it's powerful. And this type of money, in my view, is for the more sophisticated investor. That's for your first investment property, and if you plan to use it, you really, really, really got to work with a mortgage advisor who understands how to use it and how you're going to pay it back. Because this is not a 25 or a 30-year mortgage. That loan is a 1-year or a 2-year. Where if you were to do a loan with a bank, it's a 30-year, 25-year. Right? So this is just a temporary stepping stone. But it's a powerful tool. This tool here, commercial financing, is the 4th road. On this road, you need more experience. So here is something that many clients don't know. Let's say you're a real estate investor and you are actually not working. You're a full-time real estate investor now. You have a portfolio of 30, 40 properties, and you don't have a traditional job. You don't have a business. You are now full-time real estate investor. Can you get a mortgage? Who says you cannot get a mortgage? Actually, you can get a mortgage. Yes, you can get a mortgage, but under what? Under what's called commercial financing. These lenders think about real estate as a business rather than saying, oh, can you personally afford it? So under this model here, there are options, but they're looking for a more experienced investor. The numbers have to work, and it takes a lot longer to get a mortgage here. On a single-family house, you can get a mortgage in 30 days and get an approval in 5 days. Here, you can get a mortgage in 2 to 3 months, and an approval takes a month. And it costs a lot more as well. But what I wanted to open your horizon to is the money possibilities that are available to you. It's not about just, going to this one bank that you have a relationship with, and the bank says, oh yeah, we do it. No, we don't do it. Our policies and procedures say that. No, that's not how it works, guys. I wanted to open up your eyes to the money possibilities. There are so many ways on how you can go about capital and mortgages if you want to build wealth in real estate. Possibilities. Okay? So, regardless of where you are in your investment journey, you may be starting out, or you may have taken a road, and now this opened up your eyes for other options that you may not have thought about. Or maybe you've done something, and you realize there was a mistake, and you need to go back and take a different route. All right? I've seen all of these situations. This is why my team and I developed this. As mortgage brokers, we are the only brokers in Canada that does a customized financing roadmap, not a mortgage, financing plan, where we look at where you are, look at your goals in investing in real estate, tell you where the money is going to come from, help you maximize your borrowing power so the yeses continue to come through, help you structure your deals. We sit down with investors and give them a customized plan. And then they are going to shop with confidence, knowing that things will fall in place. Then when they hit a goal, they come back, we recustomize, and then they go and take the next few steps. Okay, that's how we do financing for real estate investors. So for this group today, for coming here on a Saturday, and to help you really understand the details of what I just covered, I am going to do a 1-hour master class to dig into the money path that I covered with you. It's complimentary. I'll show you how to attend it. It's probably going to be in February. All right? I'm going to dig into each of the paths. You can ask me any questions, and I will also show you the common mistakes that investors make and how you can avoid them when using these money paths. I'm also, for a limited time until Monday, I'm going to give you a copy, e-copy of my best-selling book, Canadian Real Estate Investor Financing, 7 Secrets to Getting All the Money You Want. For the ladies in the room, all the money you want to buy all the shoes you want. All right? So, guys, this is how you get a copy of the ebook and how you can book a complimentary planning session with my team to talk about your investment goals and get your customized financing roadmap and any guidance you need on mortgages right now. And lastly, register for this 1-hour complimentary masterclass where I'm going to dig deep into what I shared with you today. All right? And it's streetwisemortgages.com/connect. Thank you very much.
Thank you. That was awesome. It's really interesting because I'm at the point in my portfolio where I'm looking at commercial financing, and I'm just learning that it's that long. It takes that long to go through it. You know, I want to share kind of my story. Just to give you an example, I'm buying a new house, a family home, and I walked into TD and to get a mortgage because it's the last of the big banks that will give me a mortgage. And they pulled my credit report and they saw one property. So they gave me a $3 million mortgage. And why that's important is because when I go and get financing, they don't see all of the properties that my holding corps own. And you know, I was at the beginning of Dahlia's list there where I went to all of the A lenders first and then the B lenders. So just to kind of simplify it, a good way to approach scaling a portfolio would be to create Corporation 1 and go to Bank 1 and get as many financing and as much mortgages as you can get at Bank 1. And then you start Corporation 2, you go to Bank 2, and so on and so forth. So there's ways to navigate it, to load up with the best terms, best financing terms, and then go down that road that Dahlia talked about, which is interesting because I've recently gone down it as well, because I don't have as many options with the B's and the A's anymore. But yeah, you want to max out. And again, this is why you want to work with someone that has done what you guys want to do, because not a lot of people know that. Dahlia knows that. I know that. A few of you I know it. But that's the key to scaling. So I'm really excited about this. I'm super excited about Hamilton. I now have, I think, 12 doors in Hamilton. I made a lot of money investing in Toronto very, very early, 22 years ago. I'm seeing all of the same signs. Infrastructure, government spending, major schools. So we're going to jump into the project and then we'll go over Hamilton quickly. So this project is Corktown Condos, is located at 225 John Street, right in the downtown core, very trendy neighborhood. You can walk down the street, there's restaurants, there's bars. For those of you that know Hamilton of 10, 15 years ago, it's a completely different Hamilton. It's got a great energy, great street, great area. Developed by Slate and BMO. Slate is a massive property holder. Sean, if you want to put up your hand, he's here representing Slate today. You know, if maybe after a few slides, I'll have you just give us a bit of information about Slate. They're partnering with BMO on this project, which, you know, BMO typically finances. They're a partner. Core Architects, world-renowned architect. I like this project because it's going to be ready in 2028, and it's a low deposit, potentially 2029. Prices are starting from as low as below $1,000 per square foot. And I'll show you guys later that this is a luxury building, so first of all, it should be a premium, but this is priced incredibly competitive compared to other cities and other projects in Hamilton. Location's phenomenal. McMaster University. So what's unique about this building, I don't know any other buildings in Hamilton that has it has a shuttle. So when it's completed, it'll have a shuttle that takes students or people working in the hospital to McMaster University. It's 13 minutes from here. Walk times, this is really important. This is something we always look for when we're investing in a project. 5-minute walk to St. Joseph's. It employs, I think, 5,200 people. Future LRT stop, I'll get into that, is 4 minutes from here. That connects you to McMaster, so students are probably 15 minutes away from McMaster. GO Station, 6 minutes from here. Another really big piece to this, which I'll get into. And then McMaster University downtown campus that hosts, or houses, I guess, a lot of post-grad students. It's just 10 minutes from here. So you've got an endless amount of tenants in the area, good quality tenants. Now, this project is a luxury project. What do I mean by that? I mean the standard finishes, amenities, common areas are just, there's nothing like it in Hamilton. I don't know anything else that's going to be built to this degree. Slate, the developer, is currently building One Delisle, which is a ultra luxury building in Toronto, at Yonge and St. Clair. They recently finished Junction House, which is a luxury building in the West End. Stunning, stunning buildings. Nothing else in the Junction looks like their Junction House. So you're buying at market price, comparable prices to other projects, but you're getting a premium product, which means you're going to get a lot more rent and a lot more appreciation and resale value. Suites, this is just an example. We've given you guys some stuff. I won't spend too much time. These are standard finishes, smooth ceilings, beautiful flooring, beautiful kitchens with backsplashes, floor-to-ceiling windows. So let's talk about Hamilton. Hamilton is a market, like I said, I've been watching. When I really started looking at Hamilton was when the GO Station finally went past Aldershot and connected to Hamilton. And since then, we've seen rents especially, but also resale prices just go up very, very strong in Hamilton. Now, the way I look at it, I mentioned earlier, is markets that connect to Toronto. We look at an affordability story there. So if people can't afford to be in Toronto, they move to markets that connect to Toronto, usually through transit. Hamilton has seen a tremendous amount of price and rent growth since that train line has been completed. Government spending, so there's $7 billion of private and government money being spent or invested into Hamilton. That's remarkable. I mean, there's $4.4 billion of government spending and then private, so there's a lot of, again, why I started investing in Toronto was because a lot of private money was going there. REITs were investing there. REITs wanted their safe 5, 6, 7% return. So that we're getting a lot of that, seeing a lot of that, and the government's investing as well. There's a shortage of houses. Housing. This story is pretty common across Canada, but when things kind of go back to normal, because there's still a bit of a weird thing happening from the COVID hangover, these are the markets that are going to continue to see the supply and demand fundamentals. Hamilton's population's it's booming. It used to be a steel town, blue-collar town. It's predominantly the biggest employer. Industry is health and sciences. So you've got great tenants. So $4.4 billion of government spending. That's on all levels of government. That's municipal, provincial, and federal. They're investing in the waterfront, and they're investing in the downtown core. I grew up in Brantford, just next to downtown Hamilton. It wasn't a pretty place to go when I was young. It's completely getting revitalized. Jackson Square Mall was recently bought. It's going to be redeveloped. Cops Coliseum was recently bought. That's going to be turned into an entertainment complex. There's a lot going on. But it's also a true metropolis. So what is a metropolis? Toronto's a metropolis. It's got major schools, major universities, major hospitals. It's on the water, has transit. I can't think of another market that connects to Toronto other than Hamilton that has all those things. It's a waterfront city, and it's a school city, and it's a university, a hospital city. And then LRT line, this is a big part of why this project is a great location. 4-minute walk from the future LRT line. transit. There's a study done, I don't know if it was CMHC, but anyway, a real estate analysis company that monitored or I guess analyzed real estate values once transit got added. And there was a significant increase in just a few years with rents and a price appreciation if you're close to it. So this is, I don't know if you guys have seen this before. I've sent it out in a few of our emails. This is the future of Hamilton's waterfront. It's absolutely remarkable. And you can go to Oakville and Burlington, beautiful waterfronts, but you're not going to see that density. And that's what I'm talking about when I talk about a metropolis city. You've got a beautiful yacht club here. I used to be a member there. I used to sail around and there'd be like Steel Co. and all these, like, it wasn't pretty. But this is going to be very, very, very pretty. There's $140 million of spending going in there. There's a lot of future development. So, you know, downtown core, you don't drive to downtown Mississauga and see skyscrapers with major employers, and you don't see waterfront. So it's different, and that's why I'm investing in Hamilton the same way I invested in Toronto. I still invest in Toronto, but I'm looking at this as a value play, meaning I think there's more upside. It's not a blue chip like it is investing in Toronto. I'm confident I'm going to get my 5-6% compounded growth. But here I think there's more upside, similar to what I saw in Toronto. Student housing story, very positive. There's 37,000 plus students. That's not even including the students at the hospital. There's only 4,000 on-campus beds. So once this connects with the shuttle and the transit, it's a very positive story. I've invested in student housing. I used to own real estate in Kingston and Waterloo. It's been very consistent. The rents have been very consistent, especially with international students, and especially when you're close to a major university. So Corktown, I want to get into this project specifically. We've analyzed, you know, there's a few projects in Hamilton we really, really like. This one is different because it has that luxury component, and you're not paying the luxury price tag. As I mentioned, it's developed by Slate. Do you want to maybe touch on the partnership with Slate and BMO quickly? Because maybe not a lot of people have heard of Slate, and they've got very, very deep
I was
pockets.
going to say good morning, but good afternoon. It's 1 o'clock already, so time passed by really quick. So thank you, Ryan. My name is Sean Zaidi, Executive VP for this project. And basically going back to Slate's story, founded by two brothers out of west side of basically Burlington, and their mom actually was from Hamilton, so they have vested personal interest in that market. This company founded just over 20 years ago, and now they're in 7 different countries. We still have the head office in downtown Toronto with over $14 billion asset under management. We have offices in Frankfurt, Oslo, New York, Chicago, London, you name it. Primarily, Slate actually invested in office buildings and grocery. We have 2 REITs in the U.S. But also in the past, I would say a few years, 2016, I would say, there's a shift in their asset classes that they hold to more multiplexes and residential towers and condominiums. The story of Hamilton started a couple years back. Actually, in 2022, they went through the largest commercial transactions in history of Canada. We bought Stelco. I don't know if you guys know Stelco, 800-acre on waterfront, which is now called Steelport. So this is all owned by Slate Asset Management. We have lots of vested interest in that market, and we look at a 50-year plan. We believe Hamilton going to be the next best thing that ever happens after Toronto, right? Right now, in terms of residential footprint, Corktown is going to be our first project with many more to come. So right now we have over 20 million square feet of redevelopments in planning, 12 different condominiums from Toronto, from Junction, Hamilton, and this portfolio is only growing. We're so proud of this project. Going back to Ryan's point, 2021, we brought to the market a project called One Delisle, which was Project of the Year, picked by Stories Publications. And that project, it brought a new level of basically architecture and quality and craftsmanship to the market. And I think we're at Hanson, one of our team members here, so we're sitting around 92% sold. The average unit, 1 bedroom in that project, if you want to know in comparison to Hamilton, is $1.5 million, and that's only 500 square feet. So we sold our larger units starting from $7 million all the way to $22 million. So it's the same team that we brought to table for this project. And aside from the architects, pretty much everyone involved with Corktown, it's the same team. The reason I want to mention that, we studied so much about Hamilton's market, and with the population growth projected for this market, there was a void in the market for luxury building, right? If you look at the location of the project, we're very close to St. Joe's Hospital, with a lot of physicians, a lot of healthcare professionals, that they need something more of a cookie cutter approach, and this is by far the only option we have in the marketplace. So I'll pass it to you, Ryan.
Thank you.
Okay.
Appreciate it. And that's it. I mean, that's why we're here. This is why I brought this deal to our clients, our database. We think it's a remarkable opportunity. It is luxury, and I think it fills a gap in the market. Another, I think, important point is based on the magnitude of construction that they have, this is going to be a flagship building. They got a lot of buildings to sell over the next 25 years in Hamilton. This is going to be a flagship building. Okay, so let's get into why Corktown priced well. So these are the prices for real estate pre-construction in the different GTA markets. Hamilton is still priced below the other markets, $700 per square foot less than downtown Toronto. But the rents are actually very comparable to downtown Toronto. I think the rents are what, about 14% less in the downtown core, but there's some areas in Toronto where the rents are actually the same as in Hamilton. Which is remarkable, but I think that's the young professionals and the doctors and everything in that market. So I wanted to give you guys some real examples. I wasn't involved with these, but you could go on, this is public information. 15 Queens Street South, someone bought this particular unit for $297,000, sold it 5 years later, made a profit of $211,000. Another example, bought 5 years ago, they sold it. I would have never sold it. I would have refinanced it, probably had the same amount of money after taxes to go reinvest, but they decided to sell it, and they made $206,000 profit just around the corner from here. Not a luxury building. These are the this is a financial pro forma. My team has like a lot more financials, happy to go through with you guys, but this is an example of a unit that we really like, split 2-bedroom, large outdoor space, and based on the assumptions historically that we've looked at, I use for this example, you'll see that there's appreciation in the first year when it's completed of $51,000, but you're going to get that appreciation over, from today to 5 years. So you're probably going to be looking at about $250,000 based on 5% growth before it's completed, and then cash flow, positive cash flow based on a 4% rate of about $200. Now, this is an interesting slide my team put together. I love it. So this is, we're trying to help people build their own pension and build a portfolio. It's a long-term thing. We're here to manage your properties, help you build it, manage it, do everything. So this is an example of how to build a $2.4 million net worth for retirement. So this is a 25-year time frame. If you buy a unit today for $751,000, put down a down payment of $150,000, get a mortgage of $600,000, what it looks like with appreciation in 25 years is $2.5 million. Okay, so that's based on, I believe, a conservative 5%. Now, if you look at the cash flow, debt left in 25 years leaves you $82,000 in positive, that's what's remaining on the mortgage because we're doing a 30-year amortization. Cash flow has you at $80,000. So there's a bit of a pension there, and you've accumulated a nice nest egg. Now, if you were to buy 3 condos, for example, and look, most people aren't in a position to do that, but just to highlight that, I refinanced that property I showed you earlier, and I went and bought 3 condos in a particular building. So if you use that same example and you buy 3 instead, what it looks like in 25 years is a net worth of $7.4 million and positive cash flow of roughly $240,000. These are all assumptions. These are not guarantees, but I think we take a conservative approach. So we're happy to walk you guys through that after this if you want to sit down with my team. Now, why is this such a great deal? Okay, so we're in Hamilton. Hamilton is the market we want to be in. We know it's a luxury building. There's nothing else like it. We've negotiated some incredible incentives. Sean represents the developer. I've gone ahead and told him, look, I'm going to put in a lot of time, energy, and money to sell this project. I like it. I think it's a great investment, but I need this, that, and that from you. And this is what this is. So we've negotiated a rental guarantee, which works out to $5.10 per square foot. So depending on the size of the unit, times about 510, could be up to about a $28,000 value. Now, that's the developer, obviously, they believe in the rental market. If the rents are higher than that, you will get the higher amount, okay? And we believe they will be, but they're obviously at that number, that's what is that what we use for the financial pro forma, the rent guarantee? Yeah. Okay, cool. So the 1-year property management, that's offered by us. So we're gonna go in there, we're gonna find a tenant, we're gonna advertise, we're gonna screen the tenant, and we're gonna look after everything for you. So we wanna make this easy. We wanna make being able to scale the portfolio hands off. That's what we're gonna do. No closing costs. So this is a remarkable incentive. A lot of you guys are familiar with pre-construction. There are more closing costs with new homes, new construction, than there are with traditional resale. No closing costs. All the developer closing costs, all the developer levies, educational levies, park levies, zero.
Right, just to add, the reason we can do this, I forgot to mention, so Bank of Montreal is our equity partner in this project. This is the very first, there'll be more down the road, but this is the very first project ever that BMO has put in equity as a partner.
Right.
So they're not just lenders, they're just equity partners, and that's why we had some flexibility when it comes to deposit collections.
Right. So additional incentives, discounted parking, the shuttle. We talked about there's a Presto, that's our transit system if you want to give that to the tenant. The deposit, which Sean got to, this typically isn't possible this early in a sales cycle for a building, but because of the relationship with BMO, they're able to offer this. This is an incredible deposit, and this, for me, I want to be able to buy with as little money down as possible and then worry about the mortgage in 5 or 6 years, and this is the perfect example of that. So you've got a 10% deposit, $5,000 with the offer, balance of 5% in 30 days, 2.5% in 90 days, 2.5% in 150 days, and then 5% in January, and then the remainder on occupancy. So very, very aggressive, very spread out. And yeah, I mean, look, this is the opportunity. It's being able to invest for me. This is the way I look at it, is I'm buying in a luxury building for not luxury prices in a market that's seeing a tremendous amount of growth and has a very positive growth story, but you're tying up less capital right now to be able to invest in it.
Right.
Yeah.
What does a free assignment flip mean?
So does everyone know what an assignment is here? Does anyone know? Yeah? Okay. So assignments are when you sell your contract before it's actually completed. So, for example, if you were to buy a condo today and you wanted to sell it before getting a mortgage and putting more money down, you have the ability to do that. Don't recommend it, but a lot of people have made a lot of money assigning and flipping units. But it gives you the option. It's nice to have the flexibility of doing that. Questions? How about you do 5 minutes of questions? Go ahead.
When you sell a condo and you hold it in a corporation, you still have to pay capital gains tax?
Yes.
So then that takes away from your profits.
It does, so that's why I don't sell it. So when I was giving that example earlier, I'm refinancing it. So what I mean is, if I bought a condo for $500,000 in my corp, and today it's worth $1 million, I'm not gonna sell it because I'll pay a capital gain. I'll go to the bank and get it reassessed, and I'll be able to pull out 80% of the new amount. And I'll take that money, the $800,000, I'll pay off my mortgage, and then I'll put that money in my pocket and I won't pay tax. Does that make sense?
I have to think about that.
Just to
Well,
expand
we-
on that, if I may, so there are only 3 vehicles or opportunities that you're not gonna get taxed on. Winning the lottery, your primary residence, and life insurance. Any other forms of investment, you're gonna pay tax one way or another.
Yeah, go.
If done properly,
Yeah.
if you're buying in a company's name instead of your name, if you do it properly with planning, you don't have to pay a capital gain. What happens is you sell the company to the other person. So 100% of shares is going to other person. So you're technically not selling it. So you save on, say, all the fees and everything.
When I first started buying under corporations, I think I had 4 properties under my name, and my accountant was like, you should form a corporation for tax purposes and for liability purposes. But what I learned was that all of a sudden I started walking to banks, they didn't see the properties under the holding corps. My point to that is there's a lot of reasons why you buy under a holding corp, and I've heard of that as well. So it gives you more flexibility, for sure.
And you can even save on the land transport tax too.
Exactly. Randy, I think
You know, you were talking about population growth in Canada, so 1.2 million for 2023, okay?
Yeah.
Correct me if I'm wrong, but prior to the pandemic, year after year, for probably 30 years, it was about 250,000 a year into Canada, roughly, was it not? Give or take, like 200, 250,000?
Sure, yeah.
Right. So
All I know is into the GTA, they would need about 52 household formations, was like the 10-year average. So there's 125 ending up in the GTA.
Right.
I don't know for the rest of Canada.
So now the government came along in the pandemic and said, okay, we're going to double that to pay for the COVID bill, right? So now I see the government breaking its promises, like in many things.
Yeah.
So where do you see population growth happening from 2024 onwards? What's driving that?
Well, I mean, yeah, so first of all, this is why I like to invest in GTA, first of all, because the story we're hearing about in Alberta and Calgary was not the story we heard about 2, 3, 4, 5 years ago. Toronto and the GTA has always had those fundamentals where more people came in Ontario, they ended up in the GTA.
Jobs.
Right?
Yeah.
Right, exactly, it's jobs. Where are the employers?
Right.
Right? So that's pretty simple. So for the rest of Canada, I would be very cautious where I invested based on population growth.
Right.
You want to answer?
So 40% stat shows, because we're forecasting, we're spending billions of dollars, right? So 40% of those newcomers settling into southern Ontario, right?
Right.
And we looked at it, and with 260,000 newcomers coming between now and 2030, at the pace we're now building, we're going to be in deficit of 1 million homes by 2030. We don't need 450,000.
In the GTA specifically, yeah. So that number was 1.5 million Ontario, 1 million in GTA. And that's based on policy.
Basically, we simply can't build fast enough. That's
Yeah, and the government keeps getting in the way of building more too, keeps
That's even
thwarting
getting
that.
worse. That's even getting worse.
I read about that time and time again in that new
Yeah.
condo guide.
Yeah.
Any other questions?
I have question.
Go ahead.
Okay, when you buy a property for $500,000
Yeah.
and then it appreciates to 1 million,
Yeah.
then you refinance and you the mortgage which is on the purchase price originally, you pay down that,
Yeah.
and then you
You're left with the remainder.
and you get remainder and then you reinvest that.
Yes.
Okay, so in other words, that property has no mortgage, it's free and clear.
No, it has a new mortgage, a higher mortgage.
Okay, higher mortgage,
Yeah.
then your rent will not cover that.
Sure. So there's ways around that. I mean, depends on the situation of the property.
Yeah,
I happily have negative cash flow. I refinanced my portfolio, I think in November, I took out $1.2 million. My portfolio is now negative about $110,000 a year.
right.
Doesn't affect me, that's a write-off. I'm paying less taxes, and I've now got so I took 200,000 I put aside, I took $1 million, I went and bought more real
Okay,
estate.
that's a tax advantage.
Yeah.
Okay, but as far as the cash flow is concerned, it will be always negative.
It really depends what your goal is.
Yeah.
You're gonna build more wealth, historically speaking, through capital appreciation than cash flow.
Right,
So it's an individual question,
yeah.
but if you're trying to build the most amount of wealth, it's gonna be by focusing on capital, not on cash flow.
And then you are carrying more and more debt too.
Sure, yeah. Depending how you do it, yeah.
How do you look from the investment point of view between the 1 bedroom and 3 bedroom?
Yeah, it really depends on the market. So I would never have bought a 3-bedroom more than 5 years ago. And I bought studios and I bought 1-beds because I looked at it as it's the most affordable unit for newcomers, for young professionals. They're gonna buy that type of unit. But now what we're seeing, now rents have gone up so much that affordability is for 3 roommates to go and rent a 3-bedroom, right? But where we're mainly seeing the demand is we're now seeing families buy condos. When I started doing this 20 years ago, I mean, even up until 10 years ago, it was very difficult to sell a family a condo. You couldn't do it. I mean, first of all, there weren't a lot of 3-bedrooms. There still aren't. They make up a small percentage, single digit of all inventory, so there's less supply of it. But the demand for 3 bedrooms is increasing. It's the affordability story, right?
How about for this project, what would you recommend?
I would recommend, actually, Sean, he's done a bunch of research. This guy's the REIT billion-dollar representative.
I'm gonna tell you, just go back to supply and demand. This building, we have 372 units, okay? So in Hamilton, we do not have the mandate to provide 10% 3 bedrooms like the way we have in Toronto. So we simply don't have any 3 bedrooms, right? The rest of the building, 70% 1 bedroom, 1 plus den, and 30% 2 bedrooms. So right off the bat, you know we don't have as many 2 bedrooms, and those are the ones hot. And going back to Q1 report by 23andMe CMHC, there's a huge shortage of 2 bedrooms in Hamilton. The previous developers, they usually, in the past, they tackle to bring affordable housing, student housing, and they focus on small units. But now we have families moving to Hamilton. Do we have enough 2 bedrooms? No. So if you go on realtor.ca, rentals.ca, whatever, I just did it, just playing with it last week, there were only 9 units in the entire city of Hamilton in the market for 2 bedrooms in condos less than 10 years old.
There you go.
This is a city of
He answered the question.
750,000 people. Okay?
Sorry, she's been.
The reason actually we brought the
Let's
shuttle
let
to the
them
table is
finish.
because those people who can't buy parking, which is 1 bedroom, 1 plus bed, we have the shuttle serving the building on an hourly basis. But if you are to buy 2 bedrooms, you can buy parking with it as well.
Oh, so you get one, but you
There's-
get 1 plus and there's no
There's some larger 1 plus bed that we may or may not be able to do parking as well, but we only have enough for 2 bedrooms.
One more
So we have the
question.
shuttle.
That's amazing.
Guys, I have a whole team of people. We'll answer all your questions. I'll just answer one more for the group.
Can we do the financing before the construction finish?
Not on the unit. So you need to own it first.
Okay.
You need to have a mortgage. So what I do is I buy pre-construction. When the unit is ready, within the first few weeks, I refinance it.
When the project is ready, okay.
It's gonna be done in roughly 4 or 5 years. You're gonna go get a mortgage. And then if you wanna tap into that equity, you can refinance it within a few days and do it that quick.
Okay, and what is the rate of return on deposit for investor?
Well, it depends. I mean, so if you were to buy a $700,000 unit here and it went up 5% per year, so
Oh, so it's 5%, yeah?
we're forecasting conservatively that we think Hamilton will appreciate 5% per year.
Oh, okay, but there is no guaranteed return?
No
or-
guaranteed
no,
return.
I mean,
The rent is guaranteed.
Yearly, no, I mean yearly return on deposit, there is no?
No.
Okay.
Just to add on that, so historically speaking, there was no interest on deposit when you buy pre-construction.
Right, yeah, it's
But
good.
as of January 2023, last year,
Yeah.
so you're gonna get interest on deposit as well.
Yeah, which is significant. That adds up. Okay, guys, we're here to talk to you. Thank you very much. Thank you to my guests. It was great seeing everyone. Thank you.